Today we're going to finish up the accounting for bad debts under the allowance method. We already looked at a couple of different ways to do this: percentage of credit sales, percentage of accounts receivable, and we left off with this age trial balance of accounts receivable. As I mentioned, the age trial balance simply breaks up your total accounts receivable into different categories, and those categories are based on the number of days in which the accounts have not been paid. So a current account is within 30 days. Once it hits 30 days, it gets classified as 30 days. Then it goes to 60, and so on. So if you look at Exhibit 8.1, where the total receivables are $6,375, those are your total receivables, $6,375, and they're made up of 6 different accounts, and those accounts are now separated by the number of days that they are past due. So that the first category is 1 to 30 days. Then once they're over 30 days past due, they fall into the second category, 31 to 60, and so on. Now, over 90 days, of course, in some companies, someone asked me, 90 days overdue or 120 days overdue, you may find companies turning these accounts over to an attorney for collection. Now, the only difference between the percentage of accounts receivable and the aging is that the percentages, rather than being applied against the total balance of accounts receivable, you apply the percentages to each individual category. So rather than having one percentage against the 6375, you apply a percentage against each category. And the target balance in the allowance for bad debts is 185. So that's the balance that we want to have. Now I'm going to go over more examples today. We have lots of different examples that we're going to look at that will try to differentiate between the allowance method estimation under percentage of sales, percentage of receivables, and the age trial balance. So once again, this is what is known as a balance sheet approach. The focus is on the allowance for bad debts. We're not as concerned with the expense. And to explain what that means, if you take a look at the following example, we're going to use 185 as our target balance. In this particular example, SmartTouch begins the period with a balance, a credit balance in the allowance account of 80. They wrote off, and you know that when you write off an account in the allowance method, it is a debit to the allowance, and therefore it is going to have at that point a balance of 55. So if we put this up on the screen for you, what we're saying is that if we look at the allowance account, and 80 is, let's say, the existing balance, that 25 is a write-off, and the balance now is going to be 55. So you have an existing balance of 80, you write off 25, and now you have a balance of 55. The question that you have to ask with respect to the balance sheet approaches is that you have a target balance or a balance that you need. In this case, it was 185. So therefore, the amount of the adjustment has to be 130. And that becomes the bad debt expense. So the bad debt expense now is going to be 130. And that's the logic that we're going to use. Now, remember, the expense is forced. The expense is a byproduct of that adjustment because your concern is the balance sheet or the allowance for bad debts. No, that's the one we just did here. You'd have to determine that. It could be given. I think some of the homework problems, they give you some of the information, but you would have to take either a percentage of total accounts receivable or the aging. So let me just go back and let me bring that aging up again. So this was the age trial balance that you were working with, and it said the target balance is 185. And you get that by adding up the 1% of the first category, 2% of the second, and that's the 185. So you have to work that through to get that balance. Now, after we make that adjustment of 130, let's go back here, the bad debt expense is 130, and the allowance for bad debts has to be credited for 130. Now, the idea that the balance sheet methods will force the expense is very easy to understand. What if, for example, rather than having a balance in my case, let me go back to my rather than having a balance here of 55, what if you had 100 in here instead? If you had $100 in there and you needed 185, then your credit to the allowance is what? 85. So it changes the expense. So the expense is determined based on the existing balance in the allowance for bad debts. Right? So any balance sheet approach requires that you look at the existing balance in the allowance for bad debts. Okay, we're going to do another one now. We'll do another couple of examples. And I think just talking to people in office hours, they're going through the homework. It seems to be relatively clear, but we just want to be sure. So let's do another example, unless there are any other questions on this one. All right, so let's do another illustration. All right, let's go to this Freeman Manufacturing. And in our example, it tells us that they have credit sales of $1.2 million. And again, we assume no beginning balance. They collected $895, and accounts receivable at the end of the year is $305. Now, this is very common, and just looking at some of the homework problems a few minutes ago before we came down, it's a very common scenario that you see in some of the homework problems, so that you've got accounts receivable, and we assume a beginning balance of 0 in this problem. And you have credit sales, so you have the debit accounts receivable and credit sales for 1.2. And then we have collections of $895. Okay. All right, so that's the way the T account would look, and the ending balance would be $305. Now, of course, what you would expect to be able to do at this point is to make the entries that correspond, if you were asked, that correspond to these changes in the accounts receivable. So what entry would you make here? You would debit accounts receivable and credit sales. And that, again, is something that's common in the homework. And then here for the collections, you debit cash and credit the accounts receivable. And that's for $895. That gives you the ending balance of $305. So I'm going right to the T account because I wasn't asked to make the entries, but it depends on the problem. You may have to make the journal entries, the corresponding journal entries as well. All right, so that's the initial information that you have. Any questions on the first part of this? That's your accounts receivable. Now, of course, we need an allowance at some point. And they tell us that in the allowance account there is an existing, and I'll bring this up on the screen for you, there's an existing credit balance. So let's assume there's a beginning balance in there of $4,000. That's an existing credit balance. and they tell you that the allowance account is estimated by taking 2% of credit sales. So in this case, you're looking at what we would consider to be an income statement methodology. It's going to be an income statement approach. So you're expected to come up with the bad debt expense, and you're not worried about the allowance. So the percentage of credit sales specifies the target expense and does not really worry about the balance in the allowance for bad debts. So in this case, and I'll put this up on the screen for you because the slides are not very large. It tells you that if you're using the 2% of credit sales, you'd have a $24,000 bad debt expense that's matched with revenue, and then the allowance for bad debts is $24,000. The allowance account would then, if you look at the T account, the allowance account now goes to $28,000, and the net realizable value of accounts receivable is $28,000, because if you remember, that accounts receivable had a debit balance of $305,000. So let me again emphasize that when you use percentage of sales, this is the target. The target is to match cost with revenue. You essentially will force this based on the balance that exists there already. So again, if there was no balance there, then the adjustment would result in a balance of $24,000. If there was a $10,000 balance in there, the amount of the adjustment would be $14,000. So by using the percentage of sales, your target is the expense, and you're not as concerned with the corresponding balance in the allowance for bad debts. If the beginning balance is more than 24, well, that does happen. We're not going to see it in a textbook scenario. You would essentially reverse out some of the allowance. So you have too much, and that does happen. I think it was it was one of the textbook publishers, John Wiley, had such a large carryover balance in the allowance account, they didn't need as much, and they reversed it out. And they actually would reduce their bad debt expense, which raises income. So the question was, what happens if there is more than enough in there? Do you have to make an adjustment? Yeah.
Can you do that also at the end for taxes?
For tax purposes, again, two sets of books. Tax would use direct write-off. Yeah, the Internal Revenue would not permit you to use an estimated amount. You'd have to have an actual bad debt. Now you have to remember, once again, we use the allowance account because it's estimated, it's number one, and secondly, not only is it estimated, you really don't know at this point what accounts are going to go bad. You don't know what accounts you're not going to collect. So this becomes what we call a cushion or a provision against all of your receivables. No specific receivables. For tax purposes, you have to have a specific bad debt to write off. Okay. All right. Questions so far? Okay. I want to change from the percentage of sales method to the percentage of accounts receivable. So let's compare with that one. So let's go to the next. And in this case, I'm now going to assume that based on an analysis of 5-year collection history, you will have a collection rate, or bad debt rate, I should say, of 8.36% of your ending accounts receivable balance. Your ending accounts receivable balance is 305, and 8.36% of that is 25.5. So what you're saying is that you believe that this balance of 305 is not fully collectible. Based on your past experience, you need to have in that allowance account, this is your target balance now, you need to have 25.5 in that account based on the ending receivable balance. So you have to have 25.5, and as a result, The adjustment you need is what? 21.5. So you have to have an adjustment of 21.5. Now, again, that sort of forces the expense. What's the expense that matches cost with revenue? The percentage of credit sales is 24,000. That's the expense you really should have on your income statement. But since you're not emphasizing the income statement with this method, your focus is on the balance sheet and the net realizable value of accounts receivable, your adjustment would be 21.5. And I'll show you that entry in a second. So now, your adjustment, your adjusting entry is a debit to the bad debt expense and a credit to the allowance for bad debts. And again, that is not matched, it's forced, depending on the existing balance. And if you look at the receivable balance, it's 305, and now the ending balance of the allowance for bad debts is 25.5, of course, as that's what we needed, and the net realizable value is at 279.5. Now remember, again, that the allowance cannot be separated from the accounts receivable on the balance sheet. They are a single entity on the balance sheet. They're two separate accounts, but they're a single entity. All right, any questions on the balance sheet perspective versus the income statement perspective? We're going to do a few more, but is it clear that the income statement perspective has a target expense which results in a balance in the allowance for bad debts that may or may not give you the expected net realizable value? Net realizable value is the expected cash flow from collections in the future. It may or may not be the number that you're looking for, but you're trying to match cost with revenue. On the balance sheet side, your focus is on the proper valuation of the net realizable value or the allowance account, and you force the expense. That expense of 21.5 is short or under the number that you're looking for to match cost with revenue. Your matching is 24,000. That's the number that best matches cost with revenue, but you're a little under that amount because your emphasis is now on the balance sheet. So there's always going to be, and this is something that whether you do finance or accounting, anytime you work with financial statements, there's always going to be methods that will move numbers between the two statements. Some methods will focus on balance sheet values, other methods will focus on income statement values. We just saw one in Chapter 6, which was inventory, so that the LIFO method is focusing on the expense, higher expense in higher periods of inflation. It gives you a better match with higher sales dollars, but where was the balance sheet? It was undervalued. When you looked at FIFO, the balance sheet valuation is at current value. It's more likely to be what you would have to pay to replace that inventory, so it gives you a better balance sheet value. But it gives you a lower cost of goods sold, and it maybe overstates profits. So again, there's always a trade-off between balance sheet and income statement perspectives. All right, so any questions on that notion of forcing the expense versus forcing the allowance? All right, now, we do need to think about writing off accounts. So let's make sure we do this one more time under the allowance method. So let's take this example and let's write off an account. Let's assume that somebody with I'm going to bring this in a little bit for you. Let's assume that somebody with a balance of $25,000 is not going to pay. All right, so you determine that this person is going to be unable to pay their account. You're going to write this off against, now this is not direct write-off, so we're not going to use direct write-off. We're going to use the allowance method. You're going to write this off against the allowance account. Write-offs are a debit to the allowance and a credit to accounts receivable. Typically, you'd have a customer name here because you're going to have a subsidiary ledger. And when you write it off, notice what happens to the receivable. I'm going to put this up on the T accounts as well. So let's do a write-off. In a write-off, we're going to write off $25,000, and I'm going to bring this down as well. When we write this off against the receivable, when you write it off against the receivable, the receivable balance is now 280. So when you write it off against the receivable, its balance is going to be 280. On the allowance side, I'll just make that a little clearer. You have a balance of 25.5, I believe, right? Yep. And now the write-off is 25. So the balance now is 500. The balance is 500. So when you write it off, you debit the allowance and you credit the accounts receivable. Now at this point, the net realizable value is accounts receivable of 280 minus the allowance of 5. Okay, so it's 279.5. I'll move that up for you in a second. Sorry. Okay, so it's 279.5. Now, what was the allowance before that, before the write-off? I'm sorry. What was the net realizable value before the write-off? It was 305 minus 25.5. How much is that? 305 minus 25.5. What was the net realizable value? It was 279.5. So that's an important point, that a write-off does not change the net realizable value. A write-off under the allowance method does not change the net realizable value. So when you write off an account under the allowance method, the net realizable value of accounts receivable is unchanged. It was 279.5 before the write-off, and it is now 279.5 after the write-off. So it does not change the balance sheet. And that's because you've provided, and that's the whole notion of the allowance account, if you've provided for these losses, when they occur, it doesn't change the valuation. The valuation was expected, and when it happens, it doesn't change it. You know, as long as you're accurate. Now, obviously, you're going to make mistakes. We talked about over or underestimating, but for the most part, the idea of a simple example like this is to show you that, or at least to prove that when things are working, as long as the estimates are correct, which, you know, of course, it doesn't always work that way, but in the textbook environment, you'll always see that the write-off will not change the net realizable value. Okay. Now, what if, and this is a write-off, what if you have a subsequent recovery? And we talked about that. When you have a recovery, just to review, when you have a recovery, you have to restore the allowance and record the cash collection. So let's assume, we put this on the screen for you. Let's assume that you have a customer, or at least part of the customer balance that was written off. Let's say you collect 1.2 or $1,200. There's always two steps in a recovery. The first one restores the credit rating and puts the allowance back. It reverses out part of the write-off or the entire write-off, depending on the client, and then records the collection. So in this case, we're assuming that out of that write-off of $25,000, $1,200 is paid back. So you debit accounts receivable, credit the allowance for that amount, and then you record the collection, like as any other collection. So when there's a recovery, there's always going to be two entries that you have to make. All right. Now, one other or last balance sheet method is the aging. And I want to go through an aging with you with a little bit more detail. So if you go to the next slide, and I'll put this up on the screen for you as well. We're going to do an example of a company. And once again, it starts the year, or it starts the problem at the end of the year with accounts receivable of $10,000 and an allowance of 170. At the end of the year, you're given the following percentages regarding the aging. So we're going to tell you that if you go in there and estimate their bad debts, you have to, and again, whether you're doing this from an accounting perspective, marketing perspective, credit management in a company, this could be your company's rules that if it's current, we want to provide a 1% allowance against it. Based on our experience, 1% of current receivables are not collected, 5% of 30-day past due receivables are not collected, and so on. So these are the aging categories, and these are the percentages that we would assign. Now, what we're going to wind up doing, let me see if I can fit this. Yeah. What we'll wind up doing is taking a look at our receivables, and if you remember, when you look at an aging, there's a couple of things that should be logical, that if your total receivables are $10,000, this is coming from your subsidiary ledger. So remember, your general ledger is the control account. That has $10,000 on the balance sheet. But inside the company, you have customer names or customer numbers, and those customer accounts are individually recorded and analyzed. So customer A owes $1,900. They have $1,000 that's current, $900 that's 60 days past due. Customer B has a $3,000 account in total, and that account is current. Customer C has an account that's current for $100, $2,000 that is 30 days past due, and customer D is, obviously you're not selling currently to this customer because they haven't paid $2,500 in 90 days and they owe you $500 for more than 120 days. Now, in some cases this account would be written off. Here we're assuming we're still going to hold on to it. So these are the balances. And again, it makes sense that you don't sell to this customer because of their credit rating or their credit experience. Now, with the percentage of accounts receivable, you would take a flat percentage against the $10,000. When you use the aging, it's a little bit more precise because you go in and you take percentages of the individual categories. So if you take these percentages against the individual categories, we're going to come up with the allowance needed. That's your target balance. Now, you're not going to do a target against each category. You add that up. So the balance that you have to have in the allowance for bad debts is $1,770, and the information I gave you in the prior slide told you that you had $170 as your existing balance. So the adjustment that you would make would be $1,600. So the journal entry that you would make in this case would be a debit to the bad debt expense and a credit to the allowance for 16. Now, even though the target is $1,770, you only need $1,600 because there is already $170 in that account. So again, you already have, if you look at it from the standpoint of what we've been thinking about throughout, you've got this allowance, you've got a $170 balance, the target is $1,770, and therefore your adjustment is $1,600. So you have your target balance of $1,770 based on the aging. $170 is already in there, so the adjustment is going to be $16. Okay. Now, questions on this one before we go to one variation of this? All right. What entry should you make if the balance in the allowance account, rather than being a 170 credit balance, was a debit balance of 200? Well, if the target is 1770 and you have a negative balance of 200, then your adjustment has to be what? Has to be 1970. So in order to make this adjustment, you would have to come up with the debit to the bad debt expense and a credit to the allowance for 1970. And again, the way this works, if you want to sort of map it out with a T account, I'll put that on top this time. If there's a $200 debit balance and 1770 is the target, then 1970 is your adjustment. Right? So you have to credit that account for 1970. Okay. All right. Now, before we start looking at some questions, any questions on your side or on your part with respect to the three methods? Yes.
So if you recover 1,000 of that, your target balance would be 7,700.
If what's 100?
What?
If what was 100? I'll repeat the question.
No, if you recovered $1,000, you debit your allowance, right?
No, if you write it off.
You write it off.
If you write it off, yeah. So if you write this from now, going forward now you have the balance you need. If you have a write-off, you write it off against that balance.
Okay.
Right? It doesn't. The write-offs only affect the adjustment because they do result in that balance the way you see it there. Okay. All right. Any other questions? All right, so let's try. Try a couple of questions for you. All right, so this one, we'll start with an easy one, I think. Under both the allowance and the direct write-off methods of accounting, uncollectible accounts, the amount of bad debt expense is to be estimated at the end of the accounting period. Let's just see what we got. All right. Okay. All right, so again, let's see what we got. All right. Oh, that one kind of hurts. Aside from those people that were sleeping and then just put their clickers on now. All right, look. The direct write-off method is actual. So only the allowance method is going to use estimates. So this is false, so I'm glad I kind of asked this one, I guess. So the amount of bad debt expense estimated at the end of the period is only under the allowance method. Direct write-off is the actual uncollectible account. You wait until you know for sure that someone's not going to pay. So this one is B. Okay. Let's go to the next one. All right, I want to know what is the net realizable value of accounts receivable? Is it calculated by subtracting the bad debt expense from the accounts receivable? Okay. Okay, these are all definitions. Starting with some definitions. The last answer counts. All right. Almost the same thing. All right. Net realizable value is accounts receivable minus the allowance for bad debts, not the bad debt expense. So net realizable value is accounts receivable minus the allowance for bad debts. All right. Okay. All right. The next one, I'm just going to tell you this next one because I'm afraid to ask. Accounts receivable aging is a balance sheet method, so that's definitely true. That's true. Now, hopefully you have your copies with you. This is kind of small. I'm sorry I couldn't make it any bigger, but let's see what we got. I want you to come up with the bad debt expense. Now, these are, got exams in a couple of weeks, another one. So this is a perfect example of something you could be asked. Look at the requirement. It asks you the correct amount of the bad debt expense and the credit to the allowance. So what's the adjusting entry technically? How much is it going to be? All right. So make sure you read what you have there. It tells you the target balance. Okay, it tells you the target balance. Bad debt expense is estimated by the aging, very similar to some of the homework questions. Management estimates the target balance is $28.50. Okay. Oh. All right. All right, so let me put this on the screen for you. Let's just see before I mark this one. All right, here we go. All right, so this is what, looking forward to, maybe you're not, but just looking forward to the next exam, this is what you would have to kind of do. Okay? You have to start using T accounts, some way to sort of analyze this. So if it has a debit balance, I hope it had a debit balance, otherwise I'm not reading this yet. It had a debit balance of $600, and you want to have $28.50. How much is the adjustment? $34.50. $34.50. And the answer is, all right. All right, there's more to come. We got to keep doing these then. All right, since we're having a good time with these, let's go to another one. There we go. All right, the allowance for bad debts has a credit balance of $2,000. This is giving you some cheat time, right? Because remember, on an exam, you may have to do these in a minute. So you have bad debt expense, credit balance of $2,000, and the adjusting entry before the adjusting entry. Management is using a percentage of credit sales approach, which is an income statement approach, and net credit sales are $250. What will be the balance? Now we're looking for the balance of the allowance for bad debts. I'm not asking for the bad debt expense. I'm not asking for the journal entry. I want to know the balance, all right? So I just gave you a few more seconds there to figure that one out. Credit balance, right? All right, well, that's actually right. So, all right, so let's do that let's do that in a systematic way. All right, there's your beginning balance, and remember the percentage of credit sales approach is going to give you the target bad debt expense, not the target allowance. The allowance is kind of forced, so whatever comes out, that's what you got to live with. So in this case, it's going to be a 2% of credit sales of $250, and you go right to the debit to bad debt expense and the credit to the allowance for $5. That's your adjustment, and the balance is $7. So C is the correct answer there. All right. Okay. I'm going to try one more. And okay. All right. There's a few more back there, but and by the way, if you do try those others, I'll give you the answers for the others. But let's do one more. All right. So this one. Smart Art is a new establishment. That means it has no beginning balances. That's what that's telling you. What happened? Oh, that makes sense. Okay. I'm actually, there we go. All right, so now Smart Art is a new establishment. That means that it is a new company and has no beginning balance. During the first year, they had credit sales of 40. They collected 36. One account for 650 was written off against the allowance. Company decided to use the percentage of sales method to account for bad debt expense, and they said that 2% of credit sales of the year-end adjustment would be used. And the ending balance, once again, what is the ending balance in the allowance for bad debts? Well, that's all right. At least most of you got it right. So, all right. So let me show you how to do that. Okay. All right. So the target expense was what? 2% of credit sales, which is 40,000, right? Is that correct? So that means that the bad debt expense has to be 800. And remember, the allowance account is 4, so the answer is A. Okay. All right. So we're not going to do the rest. You could try those. These are, by the way, people were asking me for sample questions. Look at the end of the modules, especially the end of this one. There's also lots of questions on my accounting lab. If you go in there, you'll find them. Okay. Now, what I want to do is I'm going to just, I'm going to come back to module, yes?
What does the 32,000 have to do with
Nothing, no. It's the receivable balance, right? Or 36,000 on that one. Let me see. 36,000. Oh, yeah, it just told you that you had credit. Let me bring that back in. You had credit sales of 40 and collections of 36. So what I could have done, that's your accounts receivable is 4,000. And then in another question, so let's say I wanted to have a follow-up question, I could say, what's the net realizable value of accounts receivable? So, we can build, and that happens. I can give you this base data, and then I can build off this question with a series of questions. Okay? All right. What I'm going to do is I'm going to go back to learning objective 4 in a minute, but I want to stay with accounts receivable. Okay, so just go to 5 for a moment. And we're not going to do anything on this acid test ratio or this quick ratio, but what I want to do is talk to you a little bit about the inventory turnovers. What I want to do is go back to the accounting, to the cash or the operating cycle, and want to talk to you about a key ratio. Now, we already looked at inventory turnover. There is and days sales and inventory. There is a similar ratio for receivables. So we're going to skip the acid test ratio, and we're going to go into the turnover ratio. The accounts receivable turnover ratio is going to tell you how many times per year the company goes from its maximum, and I'm going to put some different numbers in here in a second, its maximum accounts receivable balance to full collection. How many times per year it goes from its maximum receivable balance to its full collection. And you could also, now I'm going to put different numbers, but we could also get, I'm just worried about the ratios or the definitions in the boxes, we could also determine how long it takes you to collect. And that's known as the days sales outstanding or the days sales in accounts receivable. So now, at this point, in terms of application of this material, if you look at a business, and as we said with the cash operating cycle, so you start with cash, and I know we have accounts payable, and we use that to buy inventory. Then hopefully we sell it. That generates an accounts receivable, and then we collect it. Okay, so this is part of the cycle. Now we'll forget about investments until the next chapter. We have to pay off our receivables, and then we put the cash back into the cycle. So this was the cash operating cycle. Now, we looked at, in Chapter 6, we looked at something known as inventory turnover or number of days sales in inventory. So we could estimate how long it takes you to sell your inventory. Remember we talked about dealers having number of days stock on hand? You could calculate that. And you could also calculate, now you'll be able to calculate the accounts receivable turnover or the days sales outstanding. So we want to find out the days inventory on hand and the days it takes you to collect. And what I thought we would do, first of all, the numbers, the financial statements in the textbook are actually wrong. They have some typos in there. So I decided to use Apple Computer. And we're going to do Apple Computer's operating cycle. And we'll find out how long it takes them to sell inventory or how many days stock they have on hand. Do they keep a lot of inventory? And a lot of this has to do with supply chain management also. How quickly could they get their inventory? If anyone's waiting for a 5S, you know that they don't have them. And my guess is they want to sell the 5Cs. Maybe they have them. They just don't want to put them in the stores. Who knows? But you can't get them. So is that going to take longer for them to sell them? So we need to look at that, and we also want to look at how long it takes them to collect. So I thought I'm going to put up, and you don't have this, you don't have to, obviously nothing to memorize, but these are Apple's financial statements. And you notice they have a very brief looking set of financials. They got their net sales, and these are all in thousands. Gross margin, which we should know about. And then remember we talked about way back in the beginning of the semester, we mentioned when you build an income statement, you generally would list expenses in the order of magnitude. And if you remember, I told you that sometimes research is more important, and you want to show that first. So you want to track Apple's research and development activities, and of course their net income, earnings per share, is that means if you hold one share of Apple stock, that you have the right, not that you're going to get it, but you have the right, if there's liquidation, to about $45 a share, right? So that's not bad. So Apple stock doing pretty well at that time in 2012. That's the last financial statements they issued. Notice their year end is September 29th. Something else that we talked about, if you remember, we said that not all companies have a fiscal year that's the same as a calendar year. Not every company ends on December 31st. So that happens to be Apple's year end. Now, if we take their balance sheet, make sure I could focus this a little bit better. Where is it? Oh, there it is. Okay. All right. So once again, current assets, everything we talked about. You notice they have cash equivalents, they have receivables and inventories. That's all we would know about right now. Everything else in here we're going to pick up throughout this course. If you go down to their liabilities, can anyone tell me what's missing? We got accounts payable, accrued expenses. Well, they have common stock in liabilities. They don't have any long-term debt. Apple doesn't have to borrow. They have so much cash, they don't have any long-term bonds, they don't have notes. They do most of their financing through common stock, right? They issue shares. They don't have to borrow. They got tons of cash. In fact, although we're not going to worry about a cash flow statement, if you go to their cash flow statement, I'm just going to point this out, that they have net income of 41, I'm bringing that down, they got 41,733 in net income, but their cash from operations is about 58.56. They got tons of cash. Obviously, you don't know this is a cash flow statement, something we really didn't do, but they have lots of cash. And they're using that cash to finance their operations, and the only other financing they do use is going to be their issuing common stock. Now, what I want to do is I want to see Apple's inventory turnover ratio. And inventory turnover is cost of goods sold divided by the average inventory. So let me put these ratios up here again for you. If we want to do the inventory turnover ratio, it's cost of goods sold divided by average inventory. Okay? And we said in that chapter that average inventory is beginning plus ending divided by 2. So that's what we mean by average inventory. Now, why do we take the average? Well, again, cost of goods sold is a flow variable. It's on the income statement. The average inventory is a static variable. It's on the balance sheet. So you want to get the average for the year. All right, so let's see if we can do Apple's inventory turnover ratio. All right. All we need to do is go to the income statement and find their cost of goods sold. So if I go to the income statement, and I'll put these numbers up on the screen in a second, their cost of goods sold is $87,846. That's their cost of sales. And if I go to their balance sheet, and I could put these up on Blackboard. Sorry, I'm going to go to their balance sheet. And if I go to their balance sheet, I find out that their inventories started the year at 776 and they ended the year at 791. By the way, notice how little inventory they carry relative to the rest of their assets, right? So they're moving their products pretty quickly. They're not carrying too much inventory. So when I put these numbers in, I already wrote these out for you. When I put these numbers in, I come up with inventory turnover of 112 times a year. They move their inventory 112 times per year, and the idea of days sales in inventory, if you divide the turnover into 365, that means on average they only have 3 days supply on hand. That's all they have is 3 days. That's how fast they move their inventory. So they must have a really good supply chain to have those items there when you want them. The new items, again, I don't know what they're doing with this 5S, but whatever it is, they normally would have 3 days. So that's pretty good. I mean, if you come up here now, that means I'm going to round this to 3 days. So they sell their inventory in 3 days. They don't have to worry too much about having cash tied up in inventory. Now, the next problem is if they collect. And we just saw that accounts receivable, right, turnover, let me go to the turnover ratio, is, do I have it here? No, I don't. Yeah. Accounts receivable turnover, put this back on the screen, is their net sales, just on the top box, it's their net sales divided by their average accounts receivable balance. Okay, so let's see what that's going to be for Apple. Okay, so net sales divided by average accounts receivable. I just worked these up today. Take their net sales divided by average accounts receivable, which you get from their balance sheet. It's 19.2 times. So they collect their receivables almost 20 times per year. That means that if you divide that into 365, they only wait 19 days for cash. So that means that from the day they invest money into their inventory to the day they collect it, it's only 22 days. And how long do you think their suppliers give them to pay back, generally? 30 days. So they got lots of cash hanging around. So they have cash that they can invest temporarily, and maybe they just started paying some dividends recently. So this is an example, and I would have used this Green Mountain Coffee that was in the textbook, but the numbers were incorrect in that set of financials they're giving you. But I thought Apple would be more interesting in the sense that it's something that, the company's always in our somewhere, especially if someone's using an Apple computer in the back. I could always see that little light shining, right? So, or if you have a iPhone, you can always see the symbol. It's always with us. It's probably everyone's got at least an Apple product in their home. Yep. Yeah, they did this year. Yeah, this year. Yeah, but at that point they had no debt. Yep. What's that? The computations? Yeah. Yeah, the numbers, I have to put these numbers up on the, I'll put these up. I'm gonna formalize this and put this up on, I'm gonna put this up on Blackboard, okay? So these, you may not be able to see this as well, but I'm gonna put this up on Blackboard. Yeah, they are borrowing now. They actually just paid dividends for the first time in 2012. Okay. All right, so just thought as an application. So that's some of the things that, some of the things that you'd be able or you should be able to do with that information. All right, so the idea is to come up with the turnover and the days. Okay. All right. Are there any other questions? And I will put that up. I'll get those up on Blackboard for you. Okay. All right. So I'll put those up on Blackboard. I'll put the financial statements up there as well. Okay. All right. So any other questions now on that? We're going to go back to learning objective 4. All right, the last part of this chapter is going to deal with notes receivable. And in some cases, notes receivable are used for sales of products. And as we said, you would use notes receivable to sell products that are very high dollar generally and durable. So you'd probably use notes to sell maybe furniture on installment plans for 3 years. You might use notes, obviously, to sell automobiles for several periods. And the note, of course, is another receivable. You could have a bad debt allowance against it. It's generally going to be evidenced by a promissory note. So the difference between accounts and notes is that notes are formal documents that require signature, generally require interest, and usually have a longer term than an account. So as you can see in the summary, the note will generally be a longer term. You would usually have an interest, and the promissory note is going to be a formal document that has to be signed. It is a document that would involve a principal amount, an interest rate, and a due date, and of course it would be signed by the person borrowing as well. The components of the note, again, the principal amount is the face amount of the note. The interest, of course, is the rate, the period, and of course it must be signed. What you have to remember is that the maturity value of the notes that we're going to be looking at, on the date of maturity, the value will be the principal amount plus the accrued interest. So in this example, the principal amount is going to be $1,000. The interest begins on September 30th. The person that is going to receive, in other words, Smart Touch Lending or Learning is lending $1,000 to the maker of the note, and it is due a year later, and it is at an interest rate of 6%. The maker of the note, the person that signs it, is the debtor. So it'll look just like accounts receivable when we first set this up. You could lend money, you can use notes receivable for sales, but the only difference for us, the key difference, is going to be the interest. So let's take a look at this note. If on September 30th they lend $1,000 to Lauren Holland for 1 year at 6%, the entry is pretty simple. You're going to debit the notes receivable to the individual, and you would credit cash. So again, you could also credit sales revenue. If this note was for a durable asset, as we said, like sometimes appliances, you could have a 3-year loan, automobiles on 3-year loans as well. Now, the question that, or at least the comment that the book makes, is what happens to the interest? I thought there was 6% interest. Again, remember that interest is not recorded until time passes. So you must have the passage of time in order for interest to accrue, so that on the day you sign the note, you don't owe any interest. It's only with the passage of time. So again, it's the point that's made on this slide, that no interest is to be recorded on the date the note is signed. You only record interest when time passes. And again, this is something we looked at earlier in the course, that interest, again, you should know this, it's simple, it's just principal times rate times time. We'll always, most of our notes will not be a year, they'd probably be less than a year. If they were, you still would state them as a fraction of a year, so that if you take a look at the annual interest on this note, if it's a $1,000 note and the interest is 6%, the factor or the fraction is 12 over 12, 100%. In this case, it is a year or a 1-year note. The problem, though, in this example is going back to something we had, I believe, in Chapter 3 with the adjusting entries, and that is the fact that you have to accrue interest for year-end financial statements. So the problem in this case is that the note is on September 30th, and the year-end is December 31st. Now, the note will mature, and let's say this is 20, and the note, do we have a date on that? No, but let's just say the note matures next year, but in this case, you've got 3 months interest you have 3 months accrued interest. So that accrued interest has to be recorded at year end. So you have 3 months accrued interest, which is going to be for the $15. So just as we always looked back in Chapter 3, out of that $60 of interest, $15 is earned in 2013, and the rest is earned in 2014. And the interest has to be recorded in the appropriate period, so that you have 3 months in 2013, and the balance 9 months here, 9 months interest, is in the following year. So at the end of 2013, you have to come up with an adjusting entry. And that adjusting entry is going to debit the interest receivable and credit interest income. Yep.
So if you're in a refund, for example, if you're paying 6% APR, if you were in a refinance and have a lower interest rate, would you have to wait till the year ends?
No, you can. It depends on the start date of the loan. So you could do it at any time. You could refinance at any point. Usually it's going to be at the beginning of a period, so you'd have a start date that's pretty discrete. Okay. All right, so then the adjusting entry you'd have to make is at December 31st, debit interest receivable, and credit your interest revenue. Now, that is the interest that is recorded for 2013. Any questions on that adjusting entry? Now, that adjusting entry is going to be made with all of your other adjustments. This is an accrual. Remember, we said accruals would involve, in this case, revenues earned, uncollected, and unrecorded at the end of the accounting period. So that is opposite of what we've done with depreciation. That's a deferral. The prepaid's deferrals. We're going to keep going back to accruals and deferrals. Now, finally, the last part of this is the entry that you need to make in, and I don't know why this came out so small, but I'll tell you what's there. The entry to collect, when you I'm going to put this on the screen for you. When you collect the interest and the note, the maturity value of that note is $1,060. The maturity value is principal plus interest. So on September 30th in the following year, the maturity value of that note, so when you collect the note on September 30th on the following year, the maturity value, that should be a U, is $1,060. It's principal plus interest. Okay, so that is the maturity value of that note. And the entry that you would make, which I'll put up on the screen in a second, would collect the $1,060 Okay, you collect the $1,060, which includes the note receivable of $1,000, the interest revenue for this period of 45, and the interest receivable for 15. So notice that revenue is 45, and out of the 60 that you collect, $15 of that is a receivable and 45 of it is revenue. And this is going to be when you collect it, and this is at maturity. So that's at the maturity date when it's collected. So what you need to know about notes, we have one other facet of this, but what you need to know about notes is going to be that you must accrue interest if the note is going to overlap the end of an accounting period. And when you collect the note, you collect the maturity value. And that maturity value is principal plus interest. And in this case, since you overlapped with an accounting period, you would have to record the total amount received, $1,060. You'd have to credit the note receivable for the face amount, and then the interest for 15 is the receivable, and then the interest earned this year is 45. All right. Any questions on that calculation? Should be, I think, relatively easy. Just have to make sure you prorate it based on the fraction of the month. Okay. All right, just one last issue, then I want to ask you a couple of questions. Sometimes notes receivable are used if, let's say you have an accounts receivable you have an accounts receivable that's not collected, and the customer said they'll be able to pay you as evidence of the debt. As evidence of the debt, you can now take that receivable and replace it with a note, or if an accounts receivable is, or I should say if a note receivable is dishonored, or if a note receivable is not paid, we can then, obviously, the note is useless, and you can transfer it to an accounts receivable. So here's an example. Let's assume that you have a loan of $80,000 to King for 90 days at 5%. The interest on that amount should be $1,000 over the 90-day period. So we're doing it by days. So 80,000 principal at 5% for 90 over 360 using a fraction. You could have also used 3 months. If you take 3/12 of that, you get the same answer. And if the note is paid, the maturity value is $81,000. They would debit cash, credit notes receivable, and of course credit interest revenue. Now the difference between this example and the illustration we had before is that in this case the note is within the same accounting period, so there's no interest receivable. I'm also going to tell you that in the event that that note is not paid, then you would have to transfer that to an accounts receivable. Okay? Transfer to an accounts receivable. Okay, got one question for you since we've got a couple of minutes. Okay. Let's try this one. Want to know what the maturity value is on towards the end, or last thing we're going to ask you. If you have a note that's $40,000 and it's 3 months at 10%, what is going to be the maturity value? All right, I just want to be sure. We got 2, 1. Used to use 360. It's sort of a common convention to use 360. Yeah, because you know why? Because it would have worked with 3/12 too. It works both ways. Okay. All right, so again, the reason why I asked this question is because a lot of people, we had a very, very simple interest question on one of the exams, on exam 1. People got it wrong there, and people are getting it wrong here, which is almost, well, half the class. So it's C, the answer is C. Okay, and it's going to be, very simply, it's going to be, let me just tell you, it's going to be 3/12. 40,000 times 3/12 times 10%. And that's it.